you have to understand what gold is, that it is money, and that as the debt is dying, the value of it's going to go pretty crazy. But as someone who bought gold like a long time ago, the volatility doesn't matter to me anymore. In 2020, it did, right?
I think we've made the low. And the issue now is how fast do we get back up and engage on the upside again? Because I think there's a point at which once we get through back to the upside, speed will pound the table again with speed and acceleration, even more so than what we had late last year into January, which was vertical, even more so. And I think a lot of this advance in silver in particular is going to be achieved by this summer.
As of April 2026, the US dollar is under significant pressure, losing roughly 1.23% over the past year, while gold has surged, recently trading higher due to safe haven buying amid geopolitical tensions and fiscal concerns. The most bullish and frequent revised gold price forecast for 2026 is a rally towards the $6,000 area. In this upside scenario, the central bank and China's retail demand are expected to remain steady in 2026 compared to 2025, and ETF flows are projected to be 75% to 100% the pace of 2025. In this video, Rafi Farber and Michael offer two complementary perspectives on the gold and silver market. Rafi Farber highlights that fiat currencies like the dollar ultimately rest on gold's historical foundation, even though debt and inflation now sit on top of that system. He further mentions that in moments of crisis or war, investors often rush into the dollar for immediate liquidity, which can temporarily weaken gold. However, Farber argues this does not change gold's fundamental role. He predicts that as debt systems break down, purchasing power will increasingly shift into gold and silver, while paper assets lose value. He emphasizes that volatility should not discourage long-term holders, since gold's value becomes clearer as financial stress increases. In his view, those who maintain real assets like gold will be in a stronger position to deploy capital and preserve purchasing power when liquidity becomes scarce. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Rafi Farber and Michael's recent interview.
I've been stacking metals since 2012. That was my first silver purchase. And I haven't spent any of them. I have some of my metals with Keith Weiner earning interest in gold and silver terms, excuse me. And I have a very small amount with me for emergencies. I mean, basically, uh, it, if you understand that metals are money, if you understand what a derivative is, that the purchasing power of the dollar comes from its origin as a gold derivative, and therefore it still is that, because all the inflation, all the other stuff is on top of the gold layer. It's not in place of it, it's on top of it. So you have gold and you have all this inflated debt on top of that. But when that goes away, like if the debt goes away because people can't pay it, the gold is still there, and so is all this stuff that's available for purchase. So then what happens is the debt can't buy anything, and the paper is mostly debt, and it's a little bit of gold, but gold is all gold and no debt. So all of the purchasing, knowing that all the purchasing power at the collapse of a currency will flow necessarily into gold and by extension silver, because silver and gold are related, even though the dollar is not a silver derivative anymore. It used to be. So just knowing that keeps me calmer, knowing that I don't have to wake up in the morning and all my shekel in my shekel account will be worth nothing, which is what's going to happen here. It doesn't matter how strong the shekel is, because the shekel is just basically the dollar, because the shekel is issued by a bank called the Bank of Israel. And what does the Bank of Israel own? Dollars. Okay. That's the transitive property. A equals B, B equals C. Okay. It's simple. There's nothing complicated about that. It's just like people are like, oh, you can't say the shekel is the dollar because the shekel is based on the Israeli economy. No, the shekel is not based on the Israeli economy. No currency is based on its economy. That doesn't make any sense. If that were true, hyperinflation would never happen, because in every hyperinflationary economy, if there's still an economy, there's still stuff in there. It's just the currency's dead. But how is that possible if the currency is the economy? It's not the economy. A currency is a derivative either of another currency, which is a derivative of gold, or it's a derivative of gold itself. So when a currency collapses, all the purchasing power goes into gold. That's what happened here in 1985. That's what's going to happen here again. And knowing that, and also knowing that during the war itself, it's not necessarily true that gold is going to go up during the war, as we see. Like, when the Iran war started, gold went down. Why? Because in the immediate fog of the whole thing, you need the most convenient liquidity that exists. And right now, that's not gold, that's the dollar. Right? Until the debt completely collapses, that's going to be the case. In the years leading up to the hyperinflation in Weimar, gold was very volatile, especially 1922, early 1923, until November 1923 when it went to infinity or a trillion or whatever it was. But you have to understand what gold is, that it is money, and that as the debt is dying, the value of it's going to go pretty crazy. But as someone who bought gold like a long time ago, the volatility doesn't matter to me anymore. In 2020, it did, right? I was underwater, and there was a huge liquidity crunch, and I lost my job because of like right before COVID, and everyone was losing their jobs because of the lockdown. So I had to figure out what to do quickly. So that was really scary. But now it's like, okay, well, gold goes up from 5,600, goes down to 4,700. I'm like, who cares? Like, I bought it at like 1,200. Like, I'm stacking not to necessarily protect my family, though. Yes, I want to protect my family. I'm stacking because I know that on the day that the dollar collapses, the shekel collapses too. Because like if the dollar can't buy anything, and it doesn't matter if the shekel is worth $2 or so if 3 shekels is worth $1 or 4 shekels is worth $1, it doesn't make a difference if the dollar is worthless, right? It's all
Yeah.
so the reason that I stack gold is because I want the most liquidity when my people need that liquidity to keep their division of labor alive. And
Yeah.
I'm trying to do the best I can to help out, and saving my family is just a side effect of that. But I want to purchase a lot of capital because I want to be able to just like the Hive deal. Like, I'm not comparing myself to Elon Musk. I'm not, but he's able to exert so much influence because he can buy Twitter for $45 billion and keep whatever's remaining of free speech alive. He's able to instill whatever good values he has in a society and save a lot of the world, frankly. I don't know how long it's going to last, but he did some important stuff, especially mostly with buying Twitter, keeping that alive,
Yeah.
because otherwise we'd still be like in a COVID hellscape where the vaccine saved everybody, and lockdowns saved so many lives, saved millions of lives according to the models, and because you wouldn't be able to say anything else on Twitter, and like everybody else would be censored. But my point is that I want to be able to influence the world with my values, and the way that I can do that realistically is with a lot of capital when it's desperately needed.
Seasoned investor Michael Oliver explains that the recent gold and silver correction has been sharp but largely sideways, describing it as a fake-out move. He notes the drop below February lows was likely a stop hunt, suggesting that the broader uptrend remains intact. He mentions that short-term indicators are now turning back in line with the longer-term bullish structure, signaling that the corrective phase may be ending. Concurrently, Oliver predicts that momentum could accelerate once key resistance levels are broken, potentially leading to a strong upside phase similar to previous multi-year gold bull cycles. He references historical rallies to suggest that large multi-fold gains are possible, with long-term targets such as $8,500 being discussed in bullish scenarios. Recent market commentary also aligns with this outlook, as major banks and analysts have continued to highlight gold's role as a hedge amid ongoing inflation concerns, high debt levels, and geopolitical uncertainty, reinforcing growing institutional interest in the metal. Let's jump into the interview.
I think the corrective process, which has been very violent and mostly sideways, if you think about it, one day in January, the last trading day of the month, you had your collapse. And it followed through a bit into the first day of February, but basically 1.5 trading days, you had the sharp drop. Since then, if you'll look at like a monthly gold chart or a monthly silver, you could draw a line sideways, up and down, violent, confusing, but violent, but sideways. There was a low in February in silver and a low in early February in gold, which we bounced off of. And then finally in March, we started to roll over again. This time we had a headline. Oh, the war. Okay. Everybody thinks, oh, you got to buy gold for war. No, you don't buy gold during wartime. War is irrelevant. Okay. Sure enough, gold went down. So anybody who bought gold thinking the war is good got killed. Okay. But as we approached that Feb low, we put out a report saying, hey, best thing to do, take out that low. Let's run the sell stops below that February low, because everybody saw that low. And if they sweated out that first drop, they said, oh, I'm going to get out if it takes out the Feb lows. We went down about 3 weeks ago and we nipped out that February price low on gold and silver. And if you'll look, punch up an hourly chart, for example, of silver and gold on that day, which was like about 3 weeks ago when silver took out its Feb low and gold took out its Feb low. We spent about 2 hours below that low and then immediately hooked back up, saying goodbye, meaning we ran the stops. Anybody who was still waiting to exit, we kicked them out, fine, and then we corked right back up in the middle of the range. I think that was the low, that low we just made 3 weeks ago. It was the fake out low. I think now it's the process of going up and engaging on the upside again. And I think once we've crossed, we measure the both markets, silver, gold, and the miners via long-term metrics and via intermediate and short-term metrics. So you could have a negative short-term view and a positive long-term view. Right now we're starting to engage the shorter-term and intermediate metrics to the upside, meaning those shorter-term timescales are now clicking back in gear with the longer-term trend, which has remained positive despite the break. So I think we've made the low. And the issue now is how fast do we get back up and engage on the upside again? Because I think there's a point at which once we get through back to the upside, speed you'll pound the table again with speed and acceleration, even more so than what we had late last year into January, which was vertical, even more so. And I think a lot of this advance in silver in particular is going to be achieved by this summer. All I did is I go back and look since gold was legalized in the U.S. When they legalized it in January 75, gold had reached 200. So we start there. It dropped 50% into 1976, down to 103. Between 1976 low and 1980, it went up 8-fold from the bear low, 8 times that price. Okay. And then it leveled off for a couple decades at a higher level. And in 2001 and 2001, it made a low in the 260 area, $260 an ounce. And over the next 10 years, it gained 8-fold. Again, different reasons, et cetera, really the ongoing reason, the decay in the money unit.
Yeah.
An 8-fold move. So it had 2 8-fold moves under far less explosive, dangerous situation than we're facing now. If we have an 8-fold move, we're going to $8,500 because our bear low was $1,050 in 2015. So 8,500 is merely to say, oh, I'm going to do it again. Big deal. Even J.P. Morgan recently came out with a projection. I think it was fundamentally based, whatever their mode of analysis. I didn't read it. I just saw the headline. 9,200, I think, was their number. Okay. At least we're getting some honesty from the big banks, and that type. And also, Morgan Stanley, chief investment officer, some months ago said, hey, quit this 60-40 rule of portfolio allocation, stocks, bonds, add 20% gold into that and cut your bonds by 20%. So there's an underlying reality here that exists, and it is not dependent upon the Iran thing. It's dependent upon other bigger things that are already built into the system, so to speak.
The big bank revised its gold forecasts and price predictions upwards after the strong rally at the beginning of the year. Gold prices have surged to record highs this year, driven by powerful macro forces reshaping the market. As investors search for a reliable gold price prediction 2026, one signal is rising above the noise. Institutional investors overwhelmingly expect gold to continue its climb. According to a Goldman Sachs Marquis survey of more than 900 institutional clients conducted November 12th to 14th, nearly 70% believe gold prices will be higher by the end of 2026. The single largest group, 36% of respondents, predicts gold will break above $5,000 per ounce within the next year. With the US dollar under pressure, rising geopolitical uncertainty, and growing institutional demand for gold, are we witnessing the early stages of a long-term monetary shift? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.